Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about something that makes pretty much every investor's stomach drop, a bear market. But what if we've been looking at it all wrong? Today, we're diving into the book Bear Market Investing Strategies to flip that fear on its head.
So let's just get right to the big question the book poses. When the market is tanking and your portfolio is just a sea of red, what do you feel? Is it your worst nightmare coming true? Or could it actually be the single greatest investment opportunity of the decade?
And hey, just to be super clear, all the big ideas we're going to unpack today are pulled straight from this book. We're just breaking down the essentials for you.
Okay, first things first, let's just admit it. We've all been there, right? That sinking feeling when the market takes a nosedive. The book calls this the bear market nightmare. And believe me, it's a totally real, totally human reaction.
And the book just nails this feeling, doesn't it? It paints that picture we all know. The news is just screaming doom and gloom. It feels like the whole economy is about to fall off a cliff. And then you log into your account and, yep, it's all red. It feels awful.
And what's crazy is that this personal fear gets put on steroids by something called herd mentality. I mean, this is deep primal stuff. It's a survival instinct. When you see everyone else running for the exits, your brain just screams, "Go run," without even stopping to ask why.
Okay, but this is where things get really interesting. This is where the book completely flips the script. What if that moment of pure panic, that feeling that makes you want to sell everything, is actually hiding a massive opportunity in plain sight?
And listen, if you take away just one thing from this, let it be this. The book argues that these moments of maximum pessimism, when everyone is absolutely convinced the world is ending, are the exact moments when real generational wealth is made. It goes against every single one of your instincts, and that's the whole point.
And hey, this isn't just some abstract theory. I mean, just look at the legendary investor, Sir John Templeton. When World War II kicked off, the markets were in a total freefall. Doomsday, right? But he didn't run. He did the exact opposite. He actually borrowed money to buy up dirt cheap shares in over 100 companies. And what happened? A few years later, his portfolio was up over 400%. He ran towards the fire.
Okay, so how do you do it? How do you actually become the kind of person who sees opportunity when everyone else is panicking? Well, the book says it all comes down to the difference between smart money and dumb money. And here's the really important part. This has nothing to do with how rich you are. Being smart money isn't about being some big Wall Street firm. It's about your process. It's having a rational, repeatable plan versus just emotionally chasing whatever stock is hot in the news that day. You get to choose which one you are.
And the cost of getting this wrong? I mean, it's staggering. A study by Bernstein Advisors found that the average active investor makes a pathetic 2.1% a year. Seriously? You would literally make more money with less risk by just buying a boring old US Treasury bill. All that stress and trading for basically nothing.
So what's going on here? Why are the results so terrible? Well, it's this classic emotional roller coaster. People hear about a hot stock. They jump in hoping for a quick buck, but they're usually buying way too late, when the price is already sky high. Then, when things inevitably cool off, they panic and sell, right at the bottom. It's the perfect strategy for buying high and selling low.
So how do you escape that trap? The book's answer is simple. You have to zoom out, way out. You have to understand that these market crashes aren't just random, chaotic events. They're actually part of a much bigger, predictable picture.
See, markets have always moved in cycles. Always. They go through these huge bubble periods where everything gets way too expensive, and then they crash. The crash feels like the main event, but it's not. The crash is just the inevitable result of the bubble that came before it.
And here's the really crucial part. Bubbles don't just pop up out of thin air. The book says every single one starts with what it calls a seed of justification. And that seed is almost always one thing: disruption. In this disruption, it tends to show up in a couple of different ways. Sometimes it's a huge technological leap. Think about the Industrial Revolution or the dot-com boom. Other times, it's a massive shift in the global economy, like when China opened its doors to the world. Both create huge, new opportunities and the seeds of the next big bubble.
All right, so we've talked about the psychology of fear, the hidden opportunities, and these big economic cycles. So now what? What do you actually do with all this information? How do you build that rational mindset for yourself?
Look, the big secret here is that the goal isn't to become some kind of market psychic who can perfectly predict the top or the bottom. That's a fool's game.
The real win is building a solid, rational process for yourself. A system that helps you filter out the noise, keep your emotions in check, and make decisions based on a plan, not on panic.
So we'll leave you with this final thought. Another downturn is coming. That's not a prediction, it's a certainty. The only real question is, what are you going to see when it happens? Because the message of this book is loud and clear. Real wealth isn't built when things are easy. It's built in the chaos. So the next time you see red, is it a nightmare or is it the opportunity you've been waiting for?
You've seen them, right? Those ads online promising a ton of free investment research? Well, today we're going to break one of those down piece by piece and see what you're really getting. And it all kicks off with a pretty enticing number.
Yep, it all kicks off with this big, bold number. The promise couldn't be clearer. You get $135 worth of top-tier investment content, and you don't have to pay a single penny. I mean, that's a heck of a hook, right? But what are you actually getting for that value?
And here it is, the whole package. You've got a video course, a few really professional-looking reports. It definitely looks like the real deal. This is the bundle they're promising you. So let's dive in and unpack it, starting with the stuff that's supposed to make you a smarter investor.
Okay, so they've basically split this offer into two big chunks. The first one, they're calling it an investor's toolkit. The idea here is to give you the building blocks, to help you build up your knowledge so you can make smarter moves in the market.
So the main event, the big ticket item here is this Company Valuation 101 video course. I mean, look at that. It makes up almost half the total value of the whole bundle. They're slapping a $67 price tag on it, so this is clearly meant to be the heavyweight champion of the package. But what's really clever here is the psychology of it all. They're not just promising you'll learn some theory. No, they're promising a repeatable process. And that's so powerful, isn't it? It's like they're saying, hey, we're going to replace all that market chaos and confusion with a simple step-by-step formula, a system that just tells you buy or don't buy. So tempting. All right, next up in our toolkit, we've got the Options 101 guide. They value this one at $17. And let's be honest, options can seem super intimidating for a lot of people, right? So this guide tries to make them feel way more approachable, and it does that with a few key promises. And this is just marketing genius. First, they completely reframe what options are. They say, hey, these aren't for gambling. They were actually invented to cut down on your risk. Then, bam, they hit you with the authority bias by dropping Warren Buffett's name. I mean, if Warren Buffett uses them, they have to be smart, right? It's a classic 1-2 punch designed to just knock out any skepticism you might have.
Okay, so that's the educational side of things. Now let's get to the part of the offer that, let's face it, a lot of people are really here for. The hot stock tips. The specific, actionable advice.
And what's interesting is where they start. It's not a buy this recommendation. It's a warning. It's a $17 report telling you about 2 stocks to sell right now. And this is such a classic move. It taps right into our fear of losing money. That psychological quirk where losing hurts about twice as much as winning feels good. So the report says these stocks are in danger of plummeting. But look at who they're targeting. These aren't some obscure, random companies. Nope. They're popular stocks, the kind that everyday investors own. They even say one is a top 5 most held stock on Robinhood. That makes the warning feel so personal, so immediate. It's like they're looking right into your portfolio. So you can see the strategy taking shape, right? The sell recommendations create a problem. They stir up fear about stocks you might already have. And then the buy recommendations, which are coming up next, swoop in with the solution, these secret or safer stocks. It's a total textbook problem solution setup. And here we go, the first buy tip. It's an AI disruptor. And get this, it's a $4 stock. That low price makes it feel so easy to jump on, almost like buying a lottery ticket. And by linking it to AI, they're plugging right into the biggest tech hype train out there. It just makes it almost irresistible. The whole story they're spinning here is that you're getting secret information. It's an under-the-radar company, which just screams, get in before everyone else finds out. It plays right into our FOMO, that fear of missing out. But even more than that, it makes you feel like an insider, like someone just handed you the secret key to getting rich. Now, the last report switches gears completely. This isn't some high-risk tech gamble. No, this one's all about safety and stability. The one dividend stock to buy and hold. This is laser-focused on a totally different type of investor, the one who's cautious, planning for the long haul,
and just want something safe and secure.
So it's all about being reliable and safe. And think about it. By offering a speculative tech stock and a super safe dividend aristocrat, they're casting a really wide net. They're trying to appeal to both the gambler and the planner inside all of us. It means there's something for pretty much every type of investor, which makes it way more likely you'll bite.
So there you have it. You get the educational stuff, you get the scary warnings, and you get tips for pretty much every kind of investor. And it all adds up to that $135 value, which of course leads to the big question. What's the catch? So what do you actually have to give them to get all this stuff? Is there some hidden fee? Are they going to ask for your credit card? And here's the answer. The only thing you have to give them is your email address. That's it. The price is just signing up for their free investing newsletter. So you're not paying with money, you're paying with your contact info, and maybe more importantly, you're paying with your attention for all the marketing they're going to send you later. When you get right down to it, why these offers work so well comes down to one thing: the mindset of an investor, especially when the market feels totally unpredictable. You know, this quote from investor Bill Ackman just nails it. When the market is volatile, yeah, it makes us nervous. But it also makes us hungry for an edge, right? For that one magic bullet. It creates this really powerful feeling that there are amazing new opportunities just waiting to be found. And these offers basically promise to hand you the treasure map. And really, that's the question this whole bundle is built to answer. It's whispering in your ear that the path to finding those big opportunities might just start right here, with this free research. It leaves you wondering, could the next big thing really be just one click away?
All right, let's talk about something that gives every investor, a pit in their stomach: bear markets. You know what I'm talking about, that sea of red in your portfolio that just triggers instant anxiety. But what if that feeling is completely wrong? What if a bear market isn't just about panicking? What if it's actually the key, the process for building serious wealth?
So yeah, this is the big question, right? Is a bear market your absolute worst nightmare? Or could it be your greatest opportunity? I mean, should you be running for the hills, or is this the moment you've been waiting for to actually build some real long-term wealth?
And you know, this isn't just some hypothetical question I'm throwing out there. This is the core idea from our source material today, Freeman Publications. They basically argue that our whole way of thinking about bear markets might be, well, completely backwards. So let's dig in and see what they mean.
Okay, first things first. Let's just acknowledge that feeling of dread. It is absolutely real. It's visceral. And you know what? It's totally normal. When the market starts to tank, it can really feel like the sky is falling. We've all been there, right? You log into your brokerage account, and it's just a wall of red. Your stomach drops. Then you turn on the TV, and every single channel is screaming about a collapse. The so-called experts are slapping a sell rating on everything you own. The vibe is just maximum pessimism. It's brutal, no doubt about it.
But here's the twist. What if that exact moment, that feeling of maximum pessimism, is actually a giant, flashing buy signal in disguise? Let's flip this whole thing on its head and really dive into that contrarian view.
And to really get this, we've got to look at history. There is no better example, seriously, than the legendary investor Sir John Templeton. This is a guy who literally built a fortune by running toward the fire when everybody else was sprinting in the opposite direction.
I mean, just look at the timing of this. It's 1939. World War II is kicking off, the world feels like it's ending, and the market is in an absolute freefall. So what does Templeton do? He borrows money. Can you believe it? He takes on debt to buy shares in 104 companies that everyone else thought were toast. And the result? A few years later, his portfolio was up by more than 400%. Just incredible.
So this story is the perfect example of what we're talking about. It takes guts, for sure, to go against the tide. But that quote really says it all. This is where big money is made. Which leads to the obvious question, right? If this is such a killer strategy, why on earth isn't everyone doing it?
Well, the answer, it turns out, is baked right into our own psychology. We're pretty much hardwired to do the exact opposite of what Templeton did. So let's talk about this powerful automatic force that just makes us want to panic.
It's something called herd mentality. Think about it. If you're in a crowded room and suddenly everyone starts running for the exit, what do? You don't stop to ask questions, you just run. It's a survival instinct. And in the market, that same instinct translates to Everyone is selling, I'd better sell too. Your gut just screams at you to follow the crowd, which is almost always at the worst possible time.
You know, this whole herd thing brings us to a really common idea in investing. This whole concept of smart money versus dumb money. But I think we've been looking at it all wrong.
Okay, so the myth goes like this. The big institutions, the hedge funds and the big banks, they're the smart money. And regular folks, retail investors like you and me, wear the dumb money. But come on, let's be real for a second. If that were actually true, giant firms like Bear Stearns and Lehman Brothers would still be in business, right?
So here's the real distinction, and this is so important. It has nothing to do with being a big institution versus an individual. It's all about whether or not you have a process. Dumb money is just reacting, right? It jumps on whatever's hot in the news. It makes emotional decisions. Smart money, on the other hand, and this could be a huge fund or it could be you, follows a disciplined process. It's based on principles, and it keeps emotions out of the driver's seat.
All right, so what's the real-world cost of not having a process? What actually happens when you invest like dumb money? Well, the numbers, they're kind of shocking.
Seriously, just think about it for a second. All the work people put in, all the research, the constant trading, the stress, checking your portfolio 10 times a day. After all that, what do you think the average active investor actually makes per year?
Get ready for this. 2.1%. That's it. According to a big study by Bernstein Advisors, that's the number. All that work, all that stress for a return that probably won't even beat inflation. I mean, that is just a staggering figure.
And just to put that into perspective, look at this. The average investor actually makes less money than if they just bought super safe U.S. Treasury bills and did, well, absolutely nothing. Let that sink in. You would have made more money by taking on basically zero risk. How on earth is that even possible?
Well, it happens because of this classic painful cycle. This is what no process looks like in the real world. Step 1, you hear about some hot new stock in the news and you buy in. Step 2, millions of other people do the same thing and the price gets totally inflated. Step 3, the price inevitably falls back down to what it's actually worth. And finally, step 4, the news goes quiet, you panic, and you sell at a loss, which is often the exact moment it's become a bargain again. It is the perfect recipe for buying high and selling low.
Okay, so how do we break out of that trap? How do we finally make that jump from being dumb money to smart money? It all comes down to a fundamental shift in your mindset.
So here's your new playbook. It's pretty simple, actually. You start to see fear not as a warning, but as an opportunity. You build a rational process, your own set of rules, and you stick to it. You tune out the 24/7 news cycle and the panic of the herd. You let your process filter the information, not your emotions. And you truly, deeply understand this one thing. Real wealth is built in bear markets, not bull markets. It's forged in the fire.
So I'll just leave you with this final thought. The next time the market drops, the next time you log into your account and see that sea of red, what are you going to see? Will you see panic or will you see a sale? Because as we've just seen, the only thing that separates those two views is having a process.
All right, today we're going to pull back the curtain on one of the most feared and, honestly, most misunderstood events in all of finance, the market crash.
You know, it's so easy to think of a market crash as this totally random, unpredictable event, right? Like a lightning strike from a clear blue sky that nobody could have possibly seen coming. But here's the thing, that's almost never how it actually works. See, when assets are priced fairly, markets don't just collapse. In fact, if you look back at pretty much any major crash in history, you'll see they follow this surprisingly predictable pattern, a 5-stage cycle. And once you understand these stages, you'll start to see the financial world in a completely new light. So, you ready to dive in? Let's walk through it together. The entire life cycle of a crash, from that very first spark all the way to the messy fallout. Okay, stage 1. It all starts here. Every single cycle kicks off with one powerful idea that just changes the game: disruption. And this is a really important point. Bubbles don't just appear out of thin air. They're not built on pure fantasy. They always start with something real. A seed of truth, a genuinely good idea, a real change that gets the ball rolling. So what do we mean by disruption? Well, it's basically anything new that just completely shakes up the old way of doing things. It's the engine of all this change, and it usually shows up in one of two ways. So, on one hand, you've got technological advancement.
Think about the steam engine kicking off the entire industrial revolution, or the internet creating industries that didn't even exist before. Then, on the other hand, you have fundamental economic change. This can be something huge, like a geopolitical shift, the fall of the Soviet Union, for example, or it could be a major policy change, like when credit standards were relaxed back in the 2000s, which, poured gasoline on the housing market. Both create these enormous new opportunities.
All right, so once that disruption really starts to catch on, we slide right into stage 2, the bull market. And this isn't Fantasyland yet. This is a justified boom, backed by real performance.
The dot-com era is a perfect case study, right? I mean, even after the big crash, truly valuable companies like Amazon were still standing. And then, from the ashes, you get giants like Google and Facebook. Their growth was totally justified by the real, tangible value they were creating. And this points to something super important. During this stage, the very idea of what value means can change. It can shift away from just pure profit to things like user growth.
And now, stage 3. This is where things start to get a little crazy. That smart, justified optimism we just talked about, it starts to morph into something else, just pure, irrational euphoria. Welcome to the mania phase. This is where the bubble really starts to inflate. The psychology behind this is absolutely fascinating. First, you get euphoria. The market's been going up for so long that people just forget it can go down. Then that triggers this intense fear of missing out, FOMO, right? Everybody and their grandma starts jumping in. Pretty soon, the prices have absolutely no connection to what the thing is actually worth. And then, for the grand finale, people and companies start borrowing tons of money, using leverage to get an even bigger slice of the pie. I mean, look at WeWork. It's a perfect example of that total disconnect from reality. At its peak, it was valued at a mind-blowing $50 billion. It was sold as this tech company, the future of work. But the crazy thing was, the bigger it got, the more money it lost. And WeWork wasn't some lone wolf. Remember Zoom? It hit a valuation that was 63 times its revenue. Let me say that again, not its profit, its sales. That is a classic textbook sign of the mania stage, where the story people are telling themselves is way more important than the actual balance sheet. So, here's the takeaway. When you start hearing people say things like this, that the old rules don't apply anymore, that legendary investors have lost their touch, that is a giant, flashing red light. It's the sound of the absolute peak. It's that moment when everyone is convinced that this time is different, which is usually right before everything comes crashing down. Because, well, eventually, it has to. Which brings us to stage 4, the pop. The music stops, the lights come on, the party is definitely over. And what's wild is that the thing that ends it all is usually something completely out of left field. That trigger has a fancy name, an exogenous shock. It's just an external event that has nothing to do with the market itself, but it's the pin that pricks the bubble. And here's the thing you have to remember. Trying to guess what the exact shock will be is a fool's errand. You can't predict it. The key isn't knowing what it will be, but just knowing that something is eventually going to show up. And when that shock finally hits, all that leverage we talked about in stage 3, it turns into pure poison. Just look at 2008. Companies like Bear Stearns and Lehman Brothers, they weren't just holding some bad assets. They were leveraged to the hilt. They were playing a game of hot potato, believing they could always find a greater fool to sell to. But when the music stopped, that debt became an anchor that pulled them under with terrifying speed.
And that leads us to the final stage, stage 5, the aftermath. This is when the dust finally settles and we can all see just how bad the damage is. For most people, it's a time of complete disgust and distrust. But for a very small group of people, it's a time of unbelievable opportunity. You know that famous Warren Buffett quote, "You only find out who's swimming naked when the tide goes out"? Well, a market crash is the tide going out. All the easy money vanishes, and suddenly all these massive frauds that were hiding in plain sight are exposed for everyone to see. And you see this happen over and over again. The dot-com bust, that's when the Enron scandal blew up. The 2008 crisis, that's when Bernie Madoff's $64 billion Ponzi scheme finally came to light. It's amazing. These schemes can thrive when everyone's euphoric, but they get absolutely demolished in the aftermath. So, for the regular person who got swept up in all the hype, this stage is just brutal. It's all anger and disgust. They feel robbed and they swear they'll never invest again. But at that exact same moment, the smart money is quietly picking through the rubble, finding incredible companies on sale for pennies on the dollar.
And that, my friends, brings the story full circle. But of course, it's never really the end, is it? Because those amazing companies, the ones bought for cheap in the wreckage, they become the foundation for the next big disruption, the next bull market, and the whole cycle kicks off all over again. This 5-stage pattern, disruption, bull market, mania, pop, and aftermath, it's timeless. Seriously. It played out with tulip bulbs in the 1600s and with tech stocks in our lifetime. The details change, but the human psychology behind it, that never changes. So the only real question left is, when you look around at the world right now, which stage do you think we're in? All right, let's jump right in. When the market starts to tank, a lot of us think the answer is some complex new strategy or a better valuation model. But what if the real fight isn't on a spreadsheet? What if it's happening right inside our own heads? That's what this is all about, the psychology of not just surviving, but actually thriving in a bear market. So let's kick things off with the most important question of all. When everything is bleeding red, why do so many people, good people, lose money? Is it because they picked the wrong stocks? Or, maybe they just didn't grasp the whole macroeconomic picture? Well, the answer is actually way simpler and a lot more human. The single biggest mistake we make is letting our ancient evolutionary instincts take the wheel. It's that deep primal fear that screams at you to run when you see the rest of the herd running. That's what makes us sell low and buy high. See, the key isn't to outsmart the market. It's to outsmart yourself. Okay, so how in the world do we do that? Well, the first big mental shift is all about perspective. It's about learning to play the long game. And honestly, there's no better way to understand this than with a fantastic real-world story about a legendary bet. Picture this. It's 2007, right on the edge of a massive financial crisis. Warren Buffett makes a very simple bet. A boring S&P 500 index fund would beat a hand-picked group of elite, sophisticated hedge funds over the next 10 years. Now, by 2009, this looked like an absolute disaster. Buffett's fund was down a staggering 50%, while the so-called smart money hedge funds, the hares in this story, were actually up 10%. But Buffett, the tortoise, he just stayed the course. And by 2017, his super simple, patient strategy had completely crushed the competition, averaging a 7% return every year compared to their measly 2.2%. And that story just perfectly illustrates one of the greatest investing quotes of all time. In the short run, the market is just a big popularity contest. It's a voting machine driven by daily news, fear, and greed. But if you wait long enough, it becomes a weighing machine where the actual fundamental value of a business is what really, truly matters in the end. Which brings us right to our next point, how to decode all that market noise. A huge chunk of that emotional, short-term thinking comes straight from the news. Headlines are designed to grab you, especially the ones about these huge market rallies. But you gotta know they often hide more than they show. Just take a look at these numbers for a second. A 48% gain, a 21% gain, and wow, a massive 72% gain. I mean, if you saw these figures flashing across your TV screen, you'd think things were incredible, right? You'd be forgiven for thinking we were in the middle of a roaring bull market. But what's the real story here? The real story is this number. Every single one of those awesome-looking rallies on the last slide, they all happened between 1929 and 1932. Yeah, the single worst 3-year stretch in the history of the U.S. stock market, a period where the market lost 90% of its value. So here's the trick. Here's the math they don't tell you. These bear market rallies are always measured from the most recent bottom, not from the peak where everything started. So for instance, that huge 72% rally, that happened after the market had already crashed from a high of 380 all the way down to 41. The rally just took it back up to 72. Now, is that a huge percentage gain? Yes, but you're still devastatingly far from where you started. It's a mathematical illusion that just preys on our hope. Okay, so we've talked about defense, right? Having that long-term view, not getting suckered by the media noise. But what about offense? How can a bear market actually be an opportunity? It all comes down to pessimism. Think about it. During a normal bull market, everyone's participating. Information spreads like wildfire, and prices adjust almost instantly. It's what you call a highly efficient market. But in a bear market, that all changes. Fear pushes people to the sidelines. The whole mood is pessimistic. So even genuinely good news about a solid company can get completely ignored because fewer people are even willing to act on it. The market becomes
inefficient.
And that inefficiency, that is your opening. When everyone else has given up, when they're too scared to even look at their portfolios, that's the moment. That's the time for a rational, patient investor to find those diamonds in the rough. Widespread pessimism is actually a massive strategic advantage, but only if you're prepared to take that contrarian view.
And this all leads us to our final and maybe the most profound piece of the entire psychological puzzle. You have to accept that markets are not and have never been perfectly rational. The economist John Maynard Keynes came up with this brilliant analogy for this whole thing. He compared the stock market to a beauty contest. But here's the twist. Your goal isn't to pick the person that you personally find the most attractive. Nope. To win, you have to pick the person you think the judges are going to find most attractive. It's the same in the market. A stock's price is often driven less by its true value and more by what investors think other investors are going to do. And this leads to his most famous and cautionary warning. You can be 100% right. You can have the most perfect fact-based analysis in the world that a stock is overvalued. But if the rest of the market decides to stay irrational, that stock's price can keep climbing for a shockingly, painfully long time.
I mean, just look at this real-world example. The famous investor Bill Gross was convinced the market was heading for a fall way back in 2014. And you know what? He was eventually proven right when things turned in 2020. But he had to wait 6 years. 6! If you don't have the patience and, just as important, the money to survive that long stretch of craziness, then being right doesn't matter one bit. You'll get wiped out long before the market finally comes around to your way of thinking. So when you boil it all down, what are we left with? This quote from Ray Dalio just says it all. Surviving a bear market, it's not about predicting the future. It's about having a really accurate understanding of reality, the reality of your own emotions, the reality of how markets actually behave, and the reality that patience is your ultimate superpower. Seeing things clearly beyond all the noise and the hysteria, that's the only real path to producing good outcomes. So the big question is, are you seeing reality or are you just seeing what your emotions want you to see?
You know, stock tips are literally everywhere. The market hype is just constant. So how do you find the actual truth in all that noise? Well, today, we're going to cut right through it with this powerful framework that can seriously protect your portfolio.
Okay, let's kick things off with a bit of a cautionary tale. Do you remember Luckin Coffee? The media absolutely loved them, called them the Chinese Starbucks, their stock just went through the roof. But here's the thing. Behind the scenes, the whole success story was a complete lie.
And yeah, this was the devastating result. The moment that fraud came to light, Luckin's shares just collapsed. We're talking 83% in a single day. It completely wiped out investors who had bought into that incredible story they were being sold.
So, this brings us to what might be the single most important question for any of us as investors, right? How do you spot the next disaster before it happens? How do you avoid the next Luckin Coffee?
Well, the answer, or at least a really good way to think about it, comes from a powerful analogy from the legendary investor Jim Chanos. He calls it the onion model of company analysis, and trust me, it is an absolute game changer for finding the truth.
So check this out. Chanos' model organizes all the information about a company into layers, just like an onion. Right at the very center, you've got the most reliable, legally required facts. But as you move outward, each layer gets, well, it gets noisier, more biased, and way less reliable.
Now, here's the mistake that most people make. They start from the outside of the onion and work their way in. You know, they hear a tip from a friend or they see some flashy news headline, and boom, they form an opinion based on pure hype. The rational process, the one we're diving into today, flips that completely on its head. You start with the facts, at the core, and then you work your way out.
All right, so let's actually go to those outer layers for a second. Let's see exactly why starting your research out there is such a dangerous trap.
Okay, let's peel back these outer layers, starting with layers 5, 4, and 3. So, layer 5, that's the Wild West of social media and, stock tips from your neighbor Bob. It's just pure noise. Then you get to layer 4. That's where you find the Wall Street analyst reports, which are often just full of conflicts of interest. And layer 3, that's the carefully staged performance of a company's earnings call.
And this quote, man, it just perfectly illustrates the problem with those earnings calls. In a real call, an analyst asked the CEO of Marriott for some insight into the next quarter, and that was his actual response. It's so often just a performance, right? It's filled with these softball questions and total non-answers, mainly because the analysts kind of depend on the very managers they're supposed to be scrutinizing. It's a tricky spot.
Okay, so now we get to the good stuff. We're reaching the heart of the onion, that inner core. This is where you find the information that just can't be spawned, it can't be fudged. This is a real investor's true secret weapon.
And this is layer 1, the 10K filing. And look, I get it. It's long, it can be pretty boring, and there are definitely no pictures. But that's its strength. The language in a 10K is heavily regulated by the SEC, which means companies are legally required to present the unvarnished truth.
And inside this, kind of boring document, you'll find absolute treasure troves of information. The business section, it tells you what the company actually does. The risk factors section lays out all the worst-case scenarios. And the financial statements, along with their notes, they reveal the real numbers.
Here's a great example. You are never, ever going to see this in a press release. In its 10K, Tesla is legally required to disclose its heavy dependence on a single person as a key risk to their business. I mean, come on, that's a critical piece of information for any investor to have, right?
And it doesn't stop there. The company also has to be totally transparent about major operational risks, like, say, potential delays or cost overruns at its key factories. This is exactly the kind of sober, factual info you need to make an informed decision, completely free from all the hype.
And here's the most important part. This information can literally predict a disaster. Think about Enron. Years before that whole scandal blew up, the company was basically disclosing its dishonest accounting schemes right there in the notes to the statements section of its 10K. The warnings were public. They were there for anyone who knew where to look.
So why are these filings so trustworthy? Well, it's because they have to follow a really strict set of rules called Generally Accepted Accounting Principles, or GAAP. And the source material for this explainer puts it perfectly. GAAP is a lot like democracy. It's not perfect, for sure, but it is the least worst system we've got for financial reporting.
Now, this is completely different from some of the other metrics you hear thrown around all the time, like EBITDA. That's earnings before interest, taxes, depreciation, and amortization. That is a non-GAAP metric. It's basically a Wall Street creation that doesn't have strict rules. And because of that, it can be, and let's be honest, often is, manipulated to paint a much, much rosier picture of a company's earnings than what's actually happening.
And guess who was a master of this? Enron, of course. One of their classic tricks was to boost their EBITDA by recognizing revenue from memorandums of understanding, so not even actual sales, that were signed with their own offshore subsidiaries. It was just pure accounting fiction.
Okay, so how do you put all of this together? How do you turn this into a simple, actionable plan that actually protects you from all the hype and misinformation out there?
Well, here it is. This is your new playbook. You always start at layer 1 with the 10K filings. Get the facts first. Only then do you start working your way out. You can use press releases to check for spin, listen to earnings calls to get a feel for management's tone, maybe read some analyst reports for specific data points, but you completely ignore the ratings and all the hype from social media.
Really, the big takeaway here is one of empowerment. I mean, we live in an age of just endless noise, right? Starting with the facts first gives you a massive advantage. It makes you a more rational, more intelligent investor. And it gives you that peace of mind that comes from knowing you've actually done the real work.
You know, we live in this incredible age where anyone, and I mean anyone, with an internet connection can access these unbiased reports for free. All the facts are public, so the only question left is, what will you uncover?
Welcome to The Explainer. Today, we're digging into a question that trips up even the most seasoned investors. When the market is tanking, what is your single biggest enemy? We're going to explore the psychology that can either make or break your portfolio when everything is flashing red. So when stocks are in a freefall, it's really easy to blame the economy or some bad news about a company. But what if the biggest threat isn't out there at all? What if it's actually sitting right between your ears? Yep, the biggest hurdle is our own mind. You know that ancient hardwired fight-or-flight response? The one that saved our ancestors from, saber-toothed tigers? Well, in a bear market, that exact same instinct can completely sabotage our financial future, pushing us to sell at the absolute worst possible time. So let's get into it. What are these mental bugs that can turn perfectly rational people into panicked investors? It turns out that long-term success isn't really about having some genius-level plan. It's about learning to sidestep the traps that your own brain sets for you.
And we're going to start with one of the most famous and maybe one of the most dangerous pieces of advice in all of finance.
We have all heard this classic Warren Buffett quote. And on the surface, it sounds so simple, almost heroic, right? But just blindly applying this without understanding the nuance behind it, that is one of the fastest ways to lose a lot of money. See, here's the critical mistake people make. They hear Buffett's words and think it's a green light to just buy any stock that's dropped in price. That's not being greedy when others are fearful. That's just confirmation bias. You've already convinced yourself it's a bargain, so you only look for the evidence that proves you right, and you ignore all the massive warning signs. And that leads us right into the next major bug, the trap of chasing things that just look cheap. Listen, just because a stock's price has fallen off a cliff doesn't automatically make it a good buy. Sometimes stocks are cheap for a very, very good reason, and they absolutely can and do go all the way to zero.
The Hertz bankruptcy is just a perfect, almost unbelievable case study. The company itself files for bankruptcy. They put out an official statement saying their stock will probably be worthless. And what happens? Retail investors flock to it. They were chasing this illusion of a bargain and completely ignoring a direct warning from the company they were buying.
Now, this kind of behavior is driven by another really powerful trap, narrative investing. As humans, we are absolute suckers for a good story. In a bull market, a cool story can be enough to send a stock to the moon. But when a bear market hits, those nice stories just evaporate. And the only thing you're left with is the cold, hard reality of the business's fundamentals. This is narrative investing in its purest, most absurd form. You had a small iced tea company that literally just added the word blockchain to its name. That's it. Nothing else changed. No new business, no new product. And the stock price exploded. That just shows you the power of a story that is completely detached from any kind of reality. Next up is the trap of reacting to headlines you don't fully understand. Remember back in April 2020? The news was everywhere with these stories that oil prices went negative. Negative. This sensationalized headline created a perfect trap for inexperienced investors. This became a classic tourist trap. Lured in by these crazy headlines, investors wandered way outside their area of expertise. They bought these complex oil funds without having any idea they were dealing with futures contracts, not, physical barrels of oil. So when the fund managers changed their strategy, which they were totally allowed to do, countless retail investors just got wiped out. Okay, so we've seen all these psychological traps. The good news is you're not defenseless. You can actually build a rational toolkit to guard your mind against these very same errors. So let's look at the first tool. The first and maybe the most powerful tool is something called second-order thinking. Most people, they see an event and they stop right at the immediate result. But the best investors, they immediately ask, and then what? They're thinking 2 or 3 moves ahead, playing chess while everyone else is playing checkers. Let's think about streaming services during the pandemic. First-order thinking was just, hey, everyone's stuck at home, user numbers are exploding, buy. But second-order thinking asks, okay, and then what? What happens when people can go outside again? How sustainable is their massive spending on content compared to their competitors? Just asking that one simple question uncovers a totally different set of risks. The next tool you need is your circle of competence. Think about it. In real life, if a pipe bursts in your house, you call a plumber because you know your limits. Investing should be exactly the same. You have to be brutally honest about what you know and, even more importantly, what you don't. Your circle of competence is your best defense, really. It stops you from chasing all the hype in areas you don't really understand, whether that's oil futures or the latest biotech craze. It basically prevents you from becoming a tourist in a game that's being played by professionals.
All right, so we've got the tools. Now let's bring it all together. How do you actually apply this stuff when your portfolio is bleeding red and you're starting to panic?
Before you ever hit that sell button in a panic, just stop and ask yourself this one simple question. Has the fundamental reason I bought this company actually changed? If the business is still solid and your original thesis for buying it is still intact, then the price drop doesn't mean the value is gone. It just means it's on sale.
Next, you have to tune out the noise. Financial TV is designed to be entertainment. It's filled with pundits who are paid to argue with each other. Ignore what they say. Instead, go look at regulatory filings and see what the most successful long-term investors are actually doing with their own money. Their actions, that's the only signal that really matters. And finally, we get to the ultimate gut check for any investor. It comes from one of the most legendary traders in history, a guy named Jesse Livermore, and it has absolutely nothing to do with charts or spreadsheets.
Your final takeaway should be this. The goal isn't just to maximize your returns at any cost. The real goal is to invest in a way that lines up with your own tolerance for risk, a way that lets you live your life without constant fear and anxiety. If your portfolio is keeping you up at night, that is a huge red flag that you've taken on too much risk for your own psychology. Adjust it, sell down to the point where you can sleep soundly, because that is the true mark of a successful strategy.
All right, let's just get right into it. A bear market can feel like a financial winter, for sure. But for an investor who's prepared, this isn't a time to hibernate. It's actually planting season. So today we're going to break down 5 key principles for turning what feels like a disaster into a major opportunity.
You know the feeling, right? You open your brokerage account, and it's just a sea of red. Every single news channel is yelling about trillions of dollars being wiped out. Your stomach is in knots, and every fiber of your being is telling you, sell it all, run for the hills. And look, that's a totally normal human reaction. But here's the thing about our instincts when it comes to investing. They're often, wrong. They're basically caveman instincts. They're designed to handle immediate physical threats, like a tiger in the bushes, not for navigating the weird psychological roller coaster of modern financial markets.
So what if we could just flip this whole situation on its head? Instead of seeing a threat, what if we see a sale? Instead of seeing danger, we see a massive discount. That mental shift, right there, is the very first step to capitalizing on what could honestly be a once-in-a-generation buying opportunity. Let's dig into how to do that.
Okay, our first principle is so important, and it sounds a little weird. In these moments of total chaos, that overwhelming urge you have to do something, anything, is often the very thing that leads to the biggest mistakes. So we have to understand the huge difference between activity and productivity. Activity is just being busy. It's constantly checking stock prices, scrolling through Reddit for hot tips, buying into some crypto you don't understand just because you feel like you have to do something. Productivity, on the other hand, is quiet. It's focused analysis. It's taking deliberate action that's based on solid principles, not on raw fear. And that productive action, it has to happen inside what we call your circle of competence. This is just a fancy way of saying stick to the industries and businesses you actually understand. I mean, can you genuinely explain simply how a bank makes money or how a software company scales? If you can't explain it to a 10-year-old, it is probably outside your circle. And think about the discipline this takes. I mean, look at Warren Buffett during the dot-com bust. All these tech giants, Intel, Microsoft, were selling for pennies on the dollar. He could have made a killing, but he didn't buy. Why? Because he straight up admitted he didn't really get their business models. He stayed in his lane, within his circle, and that discipline is a massive part of why he's so successful.
Now, that kind of discipline leads us straight into our second principle. You have to prepare yourself mentally for paper losses. Because, let me tell you, even if you buy a fantastic company at a great price, it will almost certainly go down even more before it goes up. You need to be ready for that gut punch.
To help us deal with this, the legendary investor Benjamin Graham came up with this brilliant mental model. I want you to imagine you have a business partner. His name is Mr. Market. And the only problem is he's totally unstable. He's a manic depressive, and every single day he shows up and screams a price at you for your share of the business. And his prices? They are all over the place. On his bad days, when he's deeply depressed, he's panicking and will offer you a ridiculously low price, like $20. But on his good days, he's totally euphoric and will offer you an insanely high price, maybe $300. But here's the secret. You don't have to listen to him. You don't have to trade with him at all. You can just ignore his mood swings and focus on what the business is actually worth in the long run. And this little story perfectly illustrates the difference between a paper loss and a real loss. It's so important. When the news screams that investors lost $1 trillion, that's a paper loss. Sure, the value on your screen went down, but you haven't actually lost a single cent until you panic and hit that sell button at a low price. A loss only becomes real when you sell.
So why is it so hard not to sell? Well, it's because of a powerful glitch in our brains called loss aversion. Psychologists have actually proven that the pain of losing money feels about twice as strong as the pleasure of an equivalent gain. So your brain is literally screaming at you to make the pain stop,
even if selling is the absolute worst thing you could do. Just knowing that this is how you're wired is the first step. The second is to have a plan written down before the crash, so that logic, and not this raw primal fear, is in the driver's seat.
Okay, so you've got the right mindset, you're mentally prepared. Now you need the ammunition. Principle 3 is all about keeping your powder dry. That's an old way of saying you need cash on hand ready to go for when Mr. Market gets really depressed and starts offering you incredible bargains. And to really get why this is so important, let's just look at the raw power of time and money. Say you invest $1,000 and it grows at 10% a year. Well, in 10 years, you'll have this, $2,593. Not bad at all, right? A great return. But watch what happens if you just leave it alone for another 10 years. That same $1,000 just snowballs into over $6,700. This isn't some kind of magic trick. It is the awesome, relentless power of compounding. It's your money making money for you. Now, some people try to speed this whole process up using leverage, borrowing money to invest. But in a bear market, that is like juggling with dynamite. One sharp drop can trigger what's called a margin call, forcing you to sell at the absolute worst possible moment and completely wiping you out. Compounding is the slow, steady, and much, much safer path to building real wealth. And here it is, the golden rule that makes all of this work. The money you put in the stock market should be money you can afford to not even think about, not touch, for a bare minimum of 10 years. This is what gives you the time to ride out any storm and let that compounding magic do its thing without ever being forced to sell because you need the cash for a down payment or, a new roof. And that brings us right to principle 4. If you have that long-term time horizon we just talked about, then all the daily, the weekly, even the monthly chatter from the market, it just becomes irrelevant. It's just noise. You have to learn to separate the idea of price from the idea of value. They are not the same thing. Price is what you pay. It's emotional. It's what Mr. Market is screaming about today. Value, on the other hand, is what you get. It's the real underlying long-term earning power of the business. The whole game for a smart investor is to buy a business for a price that's way below its actual value. That gap between the two, that's your margin of safety. It's the cushion that protects you if you're not 100% right. All right, we finally arrived at the most intellectually challenging principle, but honestly, it might be the most powerful one of all. Once you think you found a great investment, your job isn't done. In fact, it's really just begun. Now, you have to try your absolute best to prove yourself wrong. For this, we can actually borrow a mental model from Charles Darwin. Yeah, the evolution guy. Whenever he came up with a new theory, he would deliberately spend all his time trying to find evidence that proved him wrong. So as an investor, what does this look like? It means after you've built your case for why you should buy a stock, your next job is to actively seek out all the reasons you shouldn't. What could go wrong here? What am I missing? What's the best argument against buying this company?
Doing this is the ultimate antidote to what's called confirmation bias. Our natural tendency to only see information that confirms what we already believe. By forcing yourself to argue the other side, you get a much clearer, much more realistic view of the investment, and you end up making far more rational decisions. So there you have it. That's the playbook. Pretty simple, right? Don't just do something, stand there. Mentally prepare for your portfolio to drop. Have long-term cash ready to go. Focus on real value, not the daily price, and have the guts to challenge your own best ideas. In the end, it really all boils down to this one question. The market is driven by two powerful emotions, fear and greed. Most people get swept away by them, but if you can master your own emotions and just stick to a rational framework like this one, you can turn widespread fear into your single greatest advantage. The choice really is yours. Let's be real for a second. Your portfolio might be flying high in a bull market, but what happens when the storm hits? How do you protect it from a total crash? Well, today, we're diving into an age-old strategy for exactly that, hedging with precious metals. So, here's our game plan. First, we're going to talk about the big problem with most modern portfolios. Then, we'll get into the psychology of gold, why it's basically a hedge against fear. After that, we'll give you a toolkit with 4 different ways to actually own gold. Then we'll look at its cousin, silver, which is a whole different ballgame. And finally, we'll wrap up with some cautionary tales to help you navigate this tricky market. A lot of investors today are what you'd call long only.
Their portfolios are just stuffed with stocks, maybe some crypto, and they're having a great time while the market's going up. But the problem is, when that tide inevitably turns, they have no lifeboat. They are completely exposed. And that really brings us to a crucial question you have to ask yourself. Is your portfolio built like a fortress, ready for anything? Or is it more like a sandcastle? Looks great on a sunny day, but you know it's going to get washed away the second a big wave comes. I mean, just look at the 2008 financial crisis. It paints a pretty brutal picture, right? The S&P 500 absolutely cratered, taking a massive chunk out of people's savings. But gold? It did the exact opposite. It soared. It wasn't just a hedge. For a lot of people, it was a lifeline in a sea of red. Okay, so let's talk about gold itself, because it's a bit of an enigma. This is an asset that has almost no industrial use, yet for thousands of years, it's been seen as the ultimate safe place to put your money. So what's driving that? It's not logic or earnings reports, it's something much more basic: raw human emotion. And that's the key thing to understand. When you buy gold, you're not really just buying a shiny metal. You're basically making a bet on human psychology. You're betting on our oldest, most powerful emotion, fear. And you should probably forget that old myth about gold being a great hedge against short-term inflation. The data just doesn't really back that up consistently. No, its real power is as a sort of fear-o-meter. When people lose faith in governments, in their currency, in the whole financial system, that's when gold really shines. So are you thinking about adding some of that golden armor to your own portfolio? Well, it turns out there's more than one way to do it. Let's break down the 4 main ways you can get exposure to gold, because they each come with their own unique pros and cons. You can go old school and actually hold physical gold bars and coins in your hand, or you can trade gold ETFs with just a click of a button. You could also invest in the miners who are out there digging it up, or you can get into something a little more complex, like gold streaming companies. Before we go further, what exactly is a streaming company? Well, think of them as a special kind of bank for miners. They give a mining company cash up front to help them get the gold out of the ground. In return, they get the right to buy that gold later at a massive discount. Then they just sell it at the market price and pocket the difference. It's a pretty clever way to bet on gold without having to own a single shovel. So this table is basically your cheat sheet. Physical gold is for the purist, the person who doesn't want to trust anyone else, but you've got to figure out how to store it and keep it safe. ETFs are super easy and convenient for the click-and-trade investor. Mining stocks are for the speculator, right? They offer high risk but potentially high reward. And streaming companies are a more sophisticated play for people who want exposure to the upside without all the operational headaches of actually running a mine. And if you're thinking about physical gold, this isn't just a history lesson, it's a serious warning. Back in 1933, the US government literally ordered citizens to turn in their gold. It's a pretty stark reminder that when things get really bad, the rules you thought were set in stone can change in an instant. Okay, let's switch gears for a minute and talk about gold's cousin, silver. If gold's story is all about fear and history, silver's story is totally different. It's all about innovation, industry, and progress. It might just be a more rational kind of hedge. Here's the bottom line. Gold is a bet on human fear. Silver is a bet on human ingenuity. I mean, think about it. The smartphone in your hand, the solar panels generating electricity, tons of medical equipment. Silver is the quiet workhorse behind so much of our modern tech. Now, the relationship between these two metals has been a wild ride. For a long time, their prices were locked together. But ever since the gold standard was abandoned, that relationship has been a complete roller coaster. The price ratio between them has swung wildly, which just goes to show how unpredictable these markets can be. So, we've talked about the tools, but listen, every treasure map has a big "Here be dragons" warning on it for a reason. The precious metals market is full of passion and potential pitfalls, and the smartest investors are the ones who learn from the mistakes of others. So let me tell you about the Hunt brothers. These were 2 oil billionaires from Texas who, during the crazy inflation of the 1970s, decided they were going to try and corner the entire silver market. It was an incredibly audacious gamble that, for a moment, made them look like geniuses, right before it all came crashing down in one of the most spectacular financial disasters ever. The story of the Hunt brothers' failure leaves us with 3 huge lessons. First, having a rational argument doesn't matter when the market is emotional. Second, using massive amounts of borrowed money, leverage, is a double-edged sword that can destroy you. And third, and this is a big one, never forget That when you're winning too big, the house can just step in and change the rules of the game? And that really leaves us with a fundamental choice, doesn't it? When you're looking for a way to protect your portfolio, to safeguard your future, where do you place your bet? Do you bet on gold, a timeless monument to human fear? Or do you bet on silver, a testament to our endless drive for innovation in industry? The answer, well, that's up to you.
Hey there, and welcome. Today we're diving into the world of stock options. But forget all the high-risk speculation stuff you might have heard about. We're going to break down how you can use them for two really practical goals. Protecting your portfolio from taking a nosedive and actually generating some consistent income.
Now, I get it. If the word options just makes your brain flash with images of crazy charts and risky trades, you are definitely not alone. But, as our source material here points out, that whole reputation for being super complicated, it's just not the full picture. The tool itself is pretty straightforward. It's the strategies that can get complex, and trust me, we are sticking to the simple ones today. So here's the game plan for the next few minutes. We're going to start by making options feel a lot less intimidating. Then we'll get into the two main types. After that, we'll jump into two really practical, pretty conservative strategies, and then we'll wrap it all up with a real, honest look at the risks you need to know about. Okay, so first things first, what in the world is an option anyway? Well, at its core, it's just a contract, and its value comes from something else, usually a stock. But here's the most important part, the phrase you've got to remember. It's the right, but not the obligation. That little phrase gives you all the flexibility, and that right there is where all the power is.
All right, so every single stock option fits into one of two buckets. And once you get this difference, everything else is going to click into place. And here they are. A call option is basically a bet that a stock's price is going to go up. It gives you the right to buy. A put option is the total opposite. It's a bet the price will go down and it gives you the right to sell. Just think call up and put down. See, it's really that simple. Okay, before we get into some real-world examples, let's just quickly nail down three key terms you're going to see. First is the strike price. That's just the price you've locked in to buy or sell the stock at. Then you've got the expiration date, which is just the deadline. And finally, the premium. Think of that as the cost of the ticket. It's what you pay for the contract itself.
All right, let's make this real. Let's say you're looking at Walmart stock. It's trading at $120, and you've got a feeling it's about to go up. You could go ahead and buy a call option. So you were right. The stock shoots up to $145. Now, because you have that call option, you get to buy the stock at your locked-in strike price of $130. Then you can immediately turn around and sell it for what it's actually worth, $145. So you take that $145, subtract the $130 you paid for the stock, and then subtract the $10 premium. And bam, you've made a $5 profit for every share. A perfect little example of how a call works.
Okay, cool. Now let's just flip the whole scenario on its head. What if you thought Walmart stock was actually going to fall from that $120 price? Well, this time you'd buy a put option instead.
And what do you know? You're right again. The stock tanks and drops to $95. But your put option gives you the right to sell it at the much higher price of $110. So, to make that happen, you just buy the stock on the open market for $95 and then immediately use your contract to sell it for $110. That difference, minus the $10 premium you paid, is your profit. $5 a share. But this time, you made money because the stock price went down. Okay, let's move on to our first real strategy. Now that we know what a put is, how can we use it to play defense? This is where options get super useful for regular investors, especially when the market gets a little scary. You know what's really interesting here is comparing this to a normal stop-loss order. A stop-loss is just a trigger, and in a crazy market, the price can literally jump right past your trigger price, meaning you sell for way less than you planned. A protective put is totally different. It's an actual contract. It guarantees your exit price. It's like putting a solid floor underneath your investment. And this is absolutely crucial to understand. A protective put is not about making money. It's insurance. You actually buy it hoping you never, ever have to use it. Kind of like your car insurance, right? You're not trying to profit from it. You're just paying a small fee, the premium, to protect yourself from a total disaster. You're preserving your hard-earned capital.
Okay, so that was defense. How about we play a little offense? Let's look at a strategy for generating income, and it involves taking the other side of that trade we just talked about.
So instead of buying a put, you can actually sell one. Sometimes people call this writing a put. When you do that, you get to collect that premium, and you get it right away as instant income. See, the person buying it from you is betting the stock's going to go down. You, on the other hand, are betting it will stay the same or maybe even go up, and you're getting paid to take on that risk. But, and this is a huge but, there is a massive catch you have to understand. If you sell a put naked, and that just means without having the cash to back it up, and the stock tanks, well, your potential losses are gigantic. In the example from our source, a single bad trade could cost you $2,500. This is without a doubt the biggest mistake new traders make, and it is completely avoidable. Luckily, there's a much safer way to do this. It's called a cash-secured put. It's so simple. You just make sure you have enough cash sitting in your account to actually buy the shares at the strike price if you have to. By doing that, you completely get rid of that massive downside risk, and it transforms the strategy from a risky gamble into a pretty conservative way to generate income. Now, even when we're talking about these simple strategies, options are a powerful, powerful tool. And you know what they say? With great power comes the need for great responsibility. So let's be crystal clear about the risks involved here.
I just love this analogy from the source material. It's perfect. Options themselves aren't dangerous, but they absolutely demand respect. If you don't know what you're doing, yeah, you can cause a whole lot of damage. But if you take the time to learn the rules of the road, they can perform brilliantly for you.
So here are 3 big things to watch out for. First, leverage. Always remember that one little contract controls 100 shares of stock, so even small price changes get magnified. Second is time decay. An option is always losing a little bit of its value as it gets closer to expiring. Think of it like a melting ice cube. And finally, complexity. Just stay away from the complicated stuff. Stick to the basics until you really know what you're doing. And that really is the main takeaway here. You don't need to be some kind of Wall Street genius. By just sticking with straightforward strategies, like we talked about, protective puts for defense and cash-secured puts for income, you can make options a really valuable part of your financial toolkit. So that really leaves us with one final thought. These things aren't just abstract financial jargon. They're actual, practical tools you can use to manage risk and generate cash flow. So the real question is, now that you know the basics, how could they fit into your own investment strategy? Thanks for tuning in to this explainer. You know, thinking about the worst-case scenario, it can be pretty overwhelming, right? But what if you could take all that anxiety and channel it into a clear, totally manageable plan? Well, in this explainer, we're going to break it all down, step by step, so you can feel empowered, not panicked. All right, I want you to think about something for a second. I mean, really think about it. If everything shut down today, how long could you and your family last on just what's in your pantry and fridge right now? A week? Maybe a few days? It's a sobering thought for sure, and it really gets at a weak spot most of us have. And here's the kicker. The reason this really matters, your average supermarket only has about 2 or 3 days worth of stock on its shelves. So in a real crisis, when everybody rushes to buy things, those shelves can go bare in a flash. Look, this isn't about scaring anyone. It's just about being real about the system we all depend on every single day. So here's our game plan. We'll kick things off with the reality of a crisis. Then, we'll build your home survival kit and figure out a long-term food plan. After that, we'll pack the essential grab-and-go bag. And we'll finish up with the most important piece of the puzzle, having the right mindset. Okay, so the system's a bit fragile. We get it. But that's not a reason to panic, right? It's a reason to plan. Because having a strategy already in place is what makes the difference between a calm, controlled response and a desperate, chaotic scramble. So let's start building that strategy right at home.
All right, let's start with your home base. I mean, that's your castle, your first line of defense. We're going to put together your home survival kit. All the essentials you need to hunker down safely, even if the power is out and the usual services are down. It's all about securing that home base.
First up, power and light. Now, a generator might seem like the go-to, but think about it. They're loud and they're thirsty for fuel you might not have. A much better bet? Focusing on stuff that doesn't need the grid. I'm talking solar-powered flashlights and, this one's a biggie, a hand-cranked radio to stay in the loop. And of course, you can never go wrong with the simple, reliable backup of candles. Okay, so you've got light, but you've got to eat, right? And all that frozen food in your freezer? Yeah, that's not going to help you without power. One of the best tools you can have is a simple propane stove. They're practical and safe. Then you stock up on things like canned goods, other non-perishables, and I can't stress this enough. Clean drinking water. That is priority number one. All right, let's talk health and medicine. You'll definitely want a well-stocked first aid kit with all the basics, antiseptics, gauze, stuff like that, plus some simple painkillers. And hey, a little tip here. Generic brands are totally fine. They work just as well, so you don't need to break the bank. And it's not a bad idea to throw in some essential vitamins to help keep your immune system up. So that home kit, that's got you covered for the first few days. But if we're talking about real preparedness, we need to think bigger, longer term. And that brings us to the long-term food plan. This is all about building up a reserve that can last you not just for days, but for weeks or maybe even months. And look, the key here is not to get overwhelmed. This can seem like a huge task, so just start small. Your first goal? A solid 3-day supply. That's it. Once you've got that locked down, you can aim for 3 weeks, then 3 months. Yeah, the ultimate goal might be a full year, but this is a marathon, not a sprint. Remember, it's all about baby steps. Every little bit you do adds up. Now, when you're stocking up for the long haul, you have to change how you think about food. And this slide? It's the perfect example. Day to day, yeah, you'd probably pick brown rice over white. Healthier, right? But for survival, nope. Longevity is everything. Plain old white rice and white pasta just lasts so much longer. You have to be willing to trade your usual nutritional preferences for pure, simple shelf life. Speaking of lasting forever, check these out. These are what people call forever foods, and for good reason. Their shelf life is, well, pretty much forever. We're talking about things like honey, salt, sugar, and white rice. Think of these as the concrete foundation for your long-term food storage. They're the absolute building blocks. Okay, we've talked a lot about sheltering in place, but what happens if you can't stay home? What if you have to get out and fast? That is exactly what the grab-and-go bag is for. It's your own personal survival kit, packed and ready to go at a moment's notice. All right, let's break down what goes in this bag. We'll start with the non-negotiables. You need a 3-day supply of food that won't spoil and a manual can opener. Don't forget that. Seriously, that little thing is crucial. You'll need water, about 2 liters per person per day. And yep, that trusty hand crank radio and flashlight combo shows up again, along with a first aid kit and a whistle you can use to signal for help. So you've got the survival basics down. Now for the personal stuff. You'll want clothing that's right for the season, an extra pair of glasses or contacts if you need them, and, this one is huge, you need copies of your important documents. Passports, insurance papers, deeds to your house. Have copies, physical or digital, ready to grab. And you know what? Throw in an old-school paper map of your area. You just can't count on your phone's GPS working. Think about it. If the power is out and the whole system is down, what good is your debit card? It's basically a piece of plastic. This is where cash becomes king. Real, physical cash. And you'll want small bills, too. Trust me, nobody's going to have change for a $100 bill in a crisis. It's the best tool for buying what you need or even for bartering. Okay, as we start to wrap this up, I want to circle back to the biggest takeaway here. None of this is about being scared or waiting for the world to end. Not at all. It's about taking back a little bit of control. It's about empowerment. It's the difference between panicking and having a calm, thought-out plan you can just execute.
You've probably heard this saying, and it just hits the nail on the head. Better to have and not need than to need and not have. Really, just think of it like an insurance policy. The little bit of effort you put in now, it's for a just-in-case future. You hope you never have to use it, but if you do, man, you'll be glad you have it.
So, I'm going to leave you with a question to chew on. What is one single small thing you can do this week to be just a little more prepared? Don't try to build a bunker tomorrow. That's not the point. Maybe it's just buying a few extra cans of food or making those copies of your documents. Just pick one thing. That first step, that's always the hardest and the most important one to take. You know, market crashes, they feel like they come out of absolutely nowhere, right? Like these sudden bolts from the blue that just wipe out fortunes overnight. But are they really that random? Well, in this explainer, we're going to dissect the anatomy of a market crash. We're going to peel back the layers to see what's really going on. So what is it? What actually causes these financial fires? Is it a war, some new invention, a natural disaster? And what do we always do? We scramble around, right? Trying to find that one specific trigger, that single piece of bad news that sent everything tumbling down. But here's the thing, and this is really the core idea we're exploring today. The source material for this explainer argues that trying to find that single cause is, well, it's pointless. It's like trying to predict which exact snowflake is going to start an avalanche. The real story isn't the snowflake. It's the massive, unstable pile of snow that was just sitting there, waiting.
All right, so here's how we're going to crack this case. First, we're going to talk about that unpredictable trigger. Then we'll dive into a whole century of past crashes. After that, we'll get to the big reveal, the real culprit. Then we'll figure out how to read the warning signs. And finally, we'll put together a playbook for you. Okay, so let's start with clue number 1. That trigger for a crash, the specific event everyone points their finger at, it's just the spark. The real danger, the thing that lets a tiny little spark cause a massive explosion, is the powder keg. It's the vulnerable market conditions that have been building up, sometimes for years. So to really get this, we've got to look at the evidence, right? Let's put on our financial detective hats for a bit and go through the case files from some of the biggest crashes of the last 100 years or so. And as we do, you're going to start to see this really fascinating and frankly, very consistent pattern emerge. I mean, just look at this timeline. We go from a fight over a railroad way back at the turn of the 20th century, all the way to a global pandemic just a couple of years ago. As you can see, the triggers are all over the map, but the crashes themselves, they are a regular feature of how markets work. Okay, let's open our first case file, 1901. This whole thing started like a soap opera. You had these two groups of super rich tycoons, one of them led by J.P. Morgan, fighting over a single railroad. Investors just piled in, borrowing tons of money to get a piece of the action, pushing the stock to insane levels. Then, when the tycoons started selling off their shares, bam, panic. The whole market collapsed. All because of a squabble over one company. All right, next up, 1906, the Great San Francisco Earthquake. What's so fascinating here is the role that information, or really misinformation, played. The first reports coming over the telegraph actually downplayed the damage. But as the real devastating truth slowly trickled out, a local disaster turned into a full-blown financial panic across the entire market. Okay, let's jump forward to a time many of us probably remember, the dot-com bubble. This was just a classic case of pure excitement completely leaving reality in the dust. The promise of the internet created this frenzy for IPOs. That's when a company first sells its stock, for businesses that honestly had no clue how they were ever going to make a dime. People weren't buying businesses, they were buying a story. And get this one number just perfectly sums up the craziness. On its very first day of trading, Priceline.com was valued at $9.8 billion. At the time, that was the biggest internet IPO ever. The catch? Their main business was losing money hand over fist. It actually prompted the CEO of a rival to say, "We've got a policy here at Cheap Tickets. We need to make money." Imagine that. And it wasn't just Priceline, not by a long shot. There was this famous analysis in late 1999 that looked at 1990 major internet stocks. Their combined value was a staggering $450 billion. And their combined profit for the year? A loss of $6.2 billion. The disconnect was just, wow, the powder keg was absolutely full to the brim. And the pattern just keeps going, right? 2008, the spark was a housing crisis built on years of really bad loans. 2020, it was a totally new virus that basically shut down the world economy. A financial crisis and a health crisis, completely different triggers, but they both lit the fuse on markets that had gotten way ahead of themselves. Okay, so we've looked at all these case files, from railroad tycoons all the way to a global pandemic. It's time for the big reveal. We've seen that the trigger is always different, always unpredictable. So what's the one thing that's always the same? What is the real culprit? And here it is. This is the absolute key takeaway. The spark can be anything. A fight between companies, a natural disaster, a virus, you name it. It doesn't really matter. The real cause, the fuel for the fire, is always the same toxic mix of human emotions, euphoria and complacency. When everyone believes prices can only go up and totally forgets that risk even exists, the market becomes that powder keg, just waiting for any old spark. This famous quote from Benjamin Graham just nails it. In the short run, the market is basically a popularity contest, a voting machine. It's all about hype and what's popular. But eventually, reality has to set in. The market becomes a weighing machine where the actual value or lack of it is what really matters. That dot-com bubble is the perfect example of the voting machine turning into a weighing machine. All right, so now we know the real culprit is this dangerous mix of human emotions. The big question is, how do you actually spot this happening in real time? How can you see the fuel building up before the spark hits? The one word you really need to look out for, the big red flag, is complacency. This is what happens after a long bull market, when prices have been going up for a long time. People just get used to winning. They start to think the good times are going to roll on forever, and they completely forget that markets go down too. They forget that bear markets, when prices fall, not only can happen, they absolutely will happen. Okay, knowing all this is great, but what? So what do you actually do with this information? How do you turn all this knowledge into a real plan? Well, that brings us to our final section, building your very own bear market playbook.
First up, you've got to get good at spotting the signs of a totally over-the-top euphoric market. Things like company valuations that make no sense, or when suddenly everyone, even your barber, is giving you hot stock tips. Second, when you see those signs, have a plan and don't be afraid to act on it. That might mean taking some profits off the table and moving to cash. And third, and this is so important, remember that holding cash is not doing nothing. It's a strategic move. It protects your money and gives you the power to buy things on sale when everyone else is panicking.
And that really brings us to the final question, the thing I want to leave you with. We figured out that the root cause of these crashes isn't some external event. It's just timeless human emotion. So as technology makes trading faster and information spreads in the blink of an eye, will that help us get over these emotional traps and make markets more stable? Or is it just going to pour gasoline on the fire, amplifying the euphoria and the panic, and making the next crash even crazier?
All right, let's talk about something that's, incredibly important. How to spot a financial fraud before it's too late. Today, we're basically going to build a fraud detection toolkit. We're going to dig into the patterns behind some of history's biggest scams so you can learn the telltale signs and protect yourself.
This quote right here, it gets to a really crucial point. Frauds aren't created when the economy gets tough. That's when they get exposed. Think about it, during a big bull market, when everything's going up, it's pretty easy for these scams to just kind of float along, hidden by all the good news. But when that market turns, the tide goes out, and that's when you finally see who's been swimming naked.
So that brings us right to our first big red flag. And it's a character you've seen time and time again. It's the lone genius, right? The guru who says they have this secret method, a method that nobody else could possibly understand. And here's their number one weapon: intellectual intimidation. They just bombard you with complex jargon and really sophisticated-sounding phrases. And the goal is super simple. It's to make you feel like if you don't get it, well, that's on you. You're just not smart enough. It's such a powerful way to shut down any hard questions before they even get asked.
And once they've got you believing they're a genius, this is where our own brains start to work against us. This incredibly powerful psychological trigger called confirmation bias kicks in. It means that as soon as you've bought the story, you start looking for anything at all that proves it's true, and you'll just brush off any evidence that says it's not. You're not an investor anymore, you're a believer, and you'll get hostile to anyone who questions your hero.
Let's look at a real-world example. Think about Jeff Skilling at Enron. He built this whole culture where his strategies were just too smart and complex for regular people to get. But what was the reality? He was literally making things up as he went. That complexity was just a giant smokescreen for the fraud.
And then, of course, you've got Bernie Madoff. The guy was supposedly making these unbelievably consistent returns, like 15% a year, year after year. When really experienced traders looked at his strategy, they said, there's no way. This simple option strategy can't do that. And what was Madoff's response every single time? He'd just say his methods were too sophisticated, that they just couldn't understand his genius. It was the exact same playbook.
So, how can you tell the difference between this and someone with real expertise? Well, fraudsters use confusing jargon, they pretend they have an answer for absolutely everything, and they are incredibly secretive. The true masters, people like Warren Buffett or George Soros, they do the exact opposite. They are famous for being able to explain complex ideas simply, and maybe most importantly, they are not afraid to say, I don't know.
Okay, let's move on to our second red flag, and you'll see how it builds on that first one. This is all about the impossible promise. You know the one. The can't-miss opportunity. The one that guarantees super high returns with little or no risk.
This is one of the fundamental laws of finance, right? To get a high reward, you have to take on high risk. There's just no such thing as a free lunch. But fraudsters prey on that very human desire for easy money by promising they can break this unbreakable rule. They sell you a complete fantasy, and we all know the old saying, if it sounds too good to be true, it always, always is. Now here's where it gets really clever. They hook you with these suspicious fee structures that can actually work in two ways that seem like total opposites. You'd think that crazy high fees would be the only red flag, but sometimes the biggest warning sign of all is that there are no fees whatsoever.
So you've got two sides of the same counterfeit coin here. On one side, you have these outrageous fees, like the massive stock options Jeff Skilling was getting in Enron. That makes you think, wow, this has to be incredibly valuable if it costs this much. But then on the other side, you have zero fees, which was Madoff's hook. That makes you feel special, like you're part of some exclusive club. But here's the crazy part. Both tricks have the exact same psychological effect. They make you believe you've struck gold, which triggers that confirmation bias and completely shuts down your critical thinking. Okay, this brings us to our third and final red flag, and this one is so important. It's about spotting the difference between someone who has a real, repeatable skill and a really charismatic storyteller who maybe got lucky once or twice and is just faking the rest.
And for this, oh man, there is no better case study on the planet than Elizabeth Holmes and Theranos. Her story is a true masterclass in how to build this convincing illusion of credibility, of prestige, of genius, all while having absolutely zero substance, or even a working product, to back any of it up.
So, let's just break down her playbook step by step. First, she created the perfect pedigree. She was a Stanford dropout, which in Silicon Valley is basically shorthand for genius. Second, she got the famous backers. She packed her board with huge names, former secretaries of state, famous generals, to create this aura of unshakable legitimacy. And third, she had her secret sauce, a patent for a revolutionary technology that, and this is the key part, never ever worked.
Because here's the stone-cold reality behind that carefully built image. Elizabeth Holmes had zero competence in the medical field she claims she was about to revolutionize. She was a chemical engineering major who dropped out after her freshman year. She got lucky a few times, and when that luck ran out, she just turned to fraud. That entire empire was built on a foundation of lies.
You know, this all comes down to a really key idea called the circle of competence. Even the most brilliant people have one. For example, if Steve Jobs told you to invest in Apple, well, that would have been a skilled decision, coming from his expertise. But Jobs himself invested a ton of money in the Segway and lost it, because it was completely outside his circle of competence. See, operating outside your circle isn't skill. It's just a gamble. It's a bet on luck.
So we've looked at all these patterns and case studies. Let's pull everything together into an actual toolkit that you can use to protect yourself. So here they are, the 3 crucial red flags to always be on the lookout for. First, the genius with a secret, the person who can't or just won't explain what they do in simple terms. Second, the impossible promise, that deal that just sounds way too good to be true. And third, someone relying on luck, not skill. That dazzling storyteller whose actual expertise just doesn't line up with their grand vision.
Ultimately, it all comes down to this. The most successful frauds, they're not really about the numbers on a spreadsheet. They're about the narrative. Con artists are expert storytellers. They sell a vision, a story that we desperately want to believe is true. So the most important question you can ever ask yourself is this: what story are you buying into?